Okay, current S&P fuel gauge data subscribers know that the gauge is at very low levels currently. So I just want to review what that has meant historically for the performance of the S&P. So I've set up a simple filter here to start and said, well, if the gauge is above 60, then you can buy the S&P the next morning at the open, actually previous night at Globex. And then you have to exit it the following, at the close of the next day. This you would have captured 1,160 points over this 5.5, 6 year period. This goes back to July of 2012. If you had only owned the market when the gauge was less than 40, you would have made 16 points. Now I'm not picking this time frame selectively. The performance is actually much better the further back you go, but this gives you an idea of how it's done in the last 6 years. Now let's be a little more aggressive. Let's say I want the gauge only to be above 50. Obviously you can set it at a lower number and apply additional filters that you like. And then you're going to capture more points because you've got more data points, more events in a generally rallying market. So that's no surprise you're going to capture another 60 points or 1,220 points. But the point here is to focus on the lower line. If the gauge is less than 30, so it's in the 20s or less, then you would have lost 183 points over this 6 year period. And you're currently in the low 20s, so this is your situation as it stands today. Now let's bring into it another variable, which is actually kind of inside the S&P fuel gauge. So we're going to take it out and isolate it. And so the question is whether bond momentum, and I'm going to normalize it, I'm going to adjust it or deflate it for bond volatility so I get a consistent range here. It just helps to be able to show it visually. The question is whether when bond momentum is positive like it is here, does that mean I can assume that the market will do better in general? The reason, of course, I'm looking at this is because, quite simply, bond momentum currently is terribly negative. So if this matters, then we're going to want to be nervous. So if bond momentum is positive, you make a total of 1,160 points, and if bond momentum is negative, you actually break even, you make 20 points. So I'm not surprised you make money, because generally bonds are rallying over this time frame, and generally the S&P is rallying, so the filter will capture some of those gains, and it will not protect you in the event of significant declines, because bond momentum tends to be positive during significant declines. So it's going to be long throughout a major pullback, just like it would have been in '08. So this is not a filter that you're going to be able to use in a significant bear market. But again, I want to point at the lower line. When bond momentum was negative in a generally rallying market, you made no money. So we're going to need something else to drive the market higher going forward to make up for this problem. So I'm going to combine the two things here, and I admit there's some redundancy here. The S&P fuel gauge, as I've explained, has got a bond component in it. It's not this component, so there's a little less redundancy than it first appears. But when I put them together, I'm going to get a lot fewer events. To find both these things to be true at the same time is simply going to happen less frequently. So I'm going to have enough cases where it's not true that I'm simply not getting any trades. I'm not in the market. Nevertheless, it captured 1,060 points over this 6 year period. And again, I want to look at this lower line. When the two things are negative, or say when S&P fuel gauge is below 40 and bond momentum is negative, you lose 259 points over the 6 year period. That's a shocking, shockingly poor performance. And even though the market has been rallying lately, when those conditions prevail, it nevertheless served you well to never own the market when these two things are true. Even when the market was rallying, and you could argue that bond momentum was not a critical variable. So that's where we are now. We could say the market is rallying now because of hoped for political events like tax cuts or Obamacare repeal. But if you find these conditions are true as they are today, even during that kind of a rally, your prospective gains are at best zero.